Praise be Jesus. Hello, everyone. We wanted to reach out to our clients because we feel like what is happening in the markets is so urgent right now. It's January 6th, 2026, as we are recording this. Actually, the feast of the wise men, our firm's namesake, St. Joseph, becomes one of history's oldest known gold custodians. And we see God's plan evolve again. And he specifically shows how gold can be used to protect families, including his own son as of today. So we won't get into all the spiritual side of it, but happy feast day to all of you. And as we begin 2026, there's a few things I want to bring to your attention. First, from a market perspective, after a stellar 2025, where gold and silver were two of the top performing assets, despite what should have been early year selling pressure, as people who no longer were constrained by not wanting to pay taxes on gains in 2025 were free to do so in 2026 and roll that tax calendar another year. We didn't see that. If you didn't see it over the weekend, behind the press around Venezuela, the Department of Defense apparently invested billions to secure a smelting facility in Latin America because after naming silver as a strategically critical mineral for the future of our country last year, they are taking steps to make sure we can secure the physical. Notice they're not just out there buying the ETFs, which you really are just a claim. It's not true ownership. They know they can call up JP Morgan or whoever and get financial derivatives in gold and silver. They don't want that. Like the central banks, every one of them, they are selling financial assets to buy physical gold, not financial gold. So they're telling us, they're telegraphing how important it is. Just in recent days, what has become more clear too is the size of the demand supply imbalance that is percolating. Samsung appears to be on the threshold of releasing its new battery technology to deploy into hybrid electric vehicles. Electric vehicles using this technology, they are expecting will be able to fully charge within about 5 minutes and have a range of over 500 miles. When that comes out, if you're an electric vehicle producer, you either have to have that or you're second rate, right? People aren't going to want to live with the constraints of the prior battery technology. If Samsung just gets a 20% share with this one product, it's estimated that that product will consume the total mineable supply every year alone of silver. So forget about the increasing demand that is manifesting in solar, right? As solar becomes more efficient, what do they need? More silver. It's not something they can swap out. And remember, water filtration, computers, cell phones, the demand for silver in healthcare is huge. And yet just this one innovation would consume all the mineable supply if it fails to garner a market share leading presence. So I think what we are seeing is manifestation of what we have been talking about, right? I mean, we wrote our white paper that you can still read, and we're happy to send it to you, called Once in a Generation in 2021, talking about how this incredible moment is at hand to diversify out of financial assets and into physical gold and silver, which are going to become central on the global stage of finance. So while we see the central bank saying that it's a complete dichotomy, we feel like it is a red alert moment, And yet advisory firms have told Americans stay away from the physical. Think also about what we are seeing again, just to recap. We've seen the greatest minds in finance in recent months. Ray Dalio say, you want a 15% allocation to gold. We know what he's doing because unlike when you ask your financial advisor, what should I have? And they say 0.5% or 1%, the percent allocation you make to gold, we believe will be the single most important investment decision you're going to make for the rest of the decade. That's how critical asset allocation has been in times of major financial paradigm shifts. Dalio is doing the math. He's going back as far as we have data in the United States that's robust, 1933. That's where you come up with the 15% allocation. If you want to optimize portfolio performance, that's the number you have. It's the same number we came up with over that time frame. He's looking at the Sharpe ratio. We know exactly what he's doing. It's honestly gratifying The greatest mind of finance is coming on board after years of talking about lower numbers, and he's agreeing with our numbers, our math. We've done the work. You've got to do some of the work too, or you're going to be remorseful. Morgan Stanley, Mike Wilson, multi-trillion-dollar manager, saying 20% allocation to metal is what you need. We know what he's doing. He's shortened Dalio's time frame. He's looking from 1971. That's a legitimate time period, 1971 to today. 71 is when gold first began trading freely. 20%. And then if you look at just this century, beginning in 2000, 25 years of data, the number rises to 25%. Now, you're probably sitting there thinking, there's no way I can get to a 20, 15, 25% allocation. That's okay. Just realize that really 0% or close to it in physical gold and silver is the only wrong answer. You got to get to a closer to a target optimal allocation. Recognize, think about this. If Western investors decided they want a 2% allocation to gold, right? And that is not enough. There is no legitimate math that will tell you if you have a 2% allocation to gold in this financial debt paradigm transition that we're going through, you're going to be happy with that. You're going to be disappointed if you only had a 2%. But if 2% of Western assets went to gold, you're looking at $10,000 in all likelihood. It's not an exact science. Now recognize, clients, friends, family, I can't promise you anything. You could lose money on gold. It could go lower. There have been periods where it traded lower. But understand, you want to be thinking like a risk manager. If gold goes lower and you have this hedge in place, you're not going to be devastated, because that means if gold's going lower, everything else is going higher. All your other financial assets, your real estate. Historically, that's what happens because gold is uncorrelated. So if history no longer matters, if finance is ended, it's no longer carrying the same weight it did in terms of the laws of finance. If I'm 100% wrong, and we are seeing the peak price in gold and silver right now, and you buy into it and gold goes lower, it's okay for you as the risk manager for your family or your charity, your school, your endowment, because that means you've said, all right, this is a risky period. I'm just buying a little bit of safety historically with gold and silver. But if history still matters, if the laws of finance still matter, if debts still matter, then having this allocation, whether you ultimately decide it's 10, 15, 20, or whatever that number is, having that, history says, could be your financial life preserver. As the rest of the financial world is engulfing in flames, that's what debt does to it. You have this historical fire protection for your wealth. Again, it carries no guarantees, but it has this precedent that it has worked. So, people, what we would say to you is the markets are demonstrating this is an urgent topic, right? The market is voting. It's telling you the cost to insure your wealth is going up. Gold is now over $4,000. Silver is now over 75, again, hitting $80 an ounce. We're hoping, we're praying for a pullback. We bought metal up here. If it pulls back, it's not a disaster. We're not crying in our milk because it came lower. That's fine. We're not buying our metal for the next move for gold to 5,000 or silver to 100. We're buying it for what history suggests is way beyond that. Call us, reach out, and know, just a little advertisement here before we conclude. If you weren't aware of this, we were honored with the top rating among U.S. physical gold dealers for the retirement platform that we architected. It allows you to get wealth from your IRA, your 401k, your 403b, your Roth IRA, and financial assets. Move it into physical gold. That's in physical silver. That's different than having the ETFs where you have a claim on it. That's a derivative, but you can't take delivery of the actual gold without fabrication costs, delays, if at all, right? The cost for a high net wealth investor to allocate into physical gold in their retirement account with us is 10 basis points. What are you doing? Like, your advisors have so many people brainwashed. Oh, I got the ETF. The GLD is only 40 basis points a year. That's 4 times the cost to maintain your asset. in a physical IRA with us. You have the IAU, same thing. It's cheaper. Do you realize the upside? You're getting a free call option on exactly what the central banks are doing. They're telling us with their wallets is so important to have ownership of the physical gold, the physical silver. So don't deliberate. You got to get, we believe, to a more appropriate allocation. 1%, 2% is not going to do it for you. Look back at the Great Depression. Do the math, right? When the financial bubble burst in the 30s, 1%, 2%, it's nice, but it didn't protect you. How about in 2000? Same thing. 2008, you wanted a more material allocation. That's what Dalio, that's what Morgan Stanley, they're all realizing. So call us. Truly think it's urgent for you to do this. God bless. God bless America.